We live in an era of the unprecedented and rapid warming of the global environment due to human activities, as scorching heat waves were engulfing parts of China, Europe, and the US in the summer of 2022.
Climate change is transforming our daily life, which is being felt not only in the physical environment, but also in financial markets. For instance, sustainable investing is becoming increasingly popular as more people realize the importance of a low-carbon economy.
Given that climate change is widely expected to become more important to investors, in this CUHK Business School research white paper, we examined how institutional and retail investors perceive the risks and opportunities associated with climate change and how they will react in response. In one of the studies, we found that people are becoming better aware of the seriousness of climate change after personally experiencing abnormally warm weather. As a result, retail investors sell stocks belonging to high-emission industries. This suggests that it is by appealing to individuals' personal and salient experiences that the challenge of climate change can be most effectively tackled.
As large market participants, the actions of institutional investors, such as banks, mutual funds, pensions, and insurance companies, strongly influence the overall markets. How will these large-scale investors react to global warming? We found that they tend to gradually reduce their carbon exposure as the world becomes increasingly aware of the effects of global warming.
Yes, while some investors adjust their investment decisions in response to climate change, companies also face mounting pressure to become more environmentally friendly. So, another critical topic we looked at is whether climate risks really affect a company's business decisions. What we found is that public firms which are heavily polluting tend to reduce their carbon footprint and ramp up their investments in innovative activities, such as increasing the ratio of green patent filings.
We investigated the investment behavior of a household employed by companies in high-emission industries. We found these households tend to reduce their level of risk-taking behavior due to concerns over their own income stream. Moreover, we found that climate regulations may reinforce wealth inequality by deterring less wealthy households from participating in stock markets. Policymakers should thus seek to implement climate regulations that do not increase income risks for households employed in industries most affected by climate change regulations. Sustainable investing is becoming mainstream in the investment world. Companies, regardless of their carbon footprint, need to understand its effects on their financial as well as operational well-being. As investor behavior continues to evolve in the current era of a heightened environmental awareness.
In the future, we will continue to study the impact of climate change on investment and on the evolution of people's perceptions about climate risks as it relates to financial markets. We also look forward to continuing to explore how finance as a discipline can help to contribute to combating climate change.
To learn more about this and other topics covered in our research white paper series,
visit China Business Knowledge at CUHK.